Want to level up your skills? Get inspired on the go with the LinkedIn app. Discover expert advice.
Okay, everyone, just wanted to make a video on just really the basics of auction market theory, which is what I trade. I do not trade market profile, it is not an indicator. Also, enlarge the video because this will be in HD. So what do I have for you right here? I have for you a balance area. And this is what you see on a profile. You usually see these bulges each day. Something like that. But on a bar chart, what does this look like? It looks something like this. You know, we have these market running higher and then it coming down, trading around here, 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 whatever, coming down here, 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 here. All this shows is that these are unfair lows, which is shown by low volume, and these are unfair highs, shown by low volume. And then there's a point in the usually near the middle where there's a lot of volume. And the trick to this is taking the right trades at the right points, which are the high and low volume areas. So let's just go to present day market. You're looking at the Russell 2000. Now, how is this shown on a bar chart? You can see it right here, a balance area. You can see we have unfair highs here and unfair lows here. And we have a lot of volume traded in the middle. And we will show that by putting on a little profile right here. We have unfair highs and unfair lows and a bulge of volume in the middle. Now the trick is trading at the extremes, which are the 95s in this case and the 93s in this case. And when you trade at these extremes, your risk to reward increases greatly. And you will also be able to find key areas on the profile, which are shown by single prints. Selling tails, buying tails. Here's another selling tail, and then the high volume nodes and the highs of days and stuff like that. So I'm just gonna go over an example trade I made in oil today. I entered it right over here. So let's just go through an overview of what was going through my mind in this trade. We knew we had balance here. We had an unfair high and an unfair low. So you want to be taking trades in and around these areas. Let's extend this a bit. It began to break out and we built value lower. That means that the market is officially in a downtrend. Once that was broken and we built value higher, and we got accepted back into this value area, which means that there is a buyer stepping in as prices went lower. Usually when a market breaks out one way, fails, and gets accepted back into the volume, it's going to go to the other side. And that's just a known fact. And that's kind of what I was playing. So what I did was I used the big profile, which is this one right here. And what I did was I took a trade at the extreme of it, but also at the extreme of a smaller one. And what I'm going to do is I'm going to take the trade at the extreme of the smaller one and have the risk of that, but the reward of the big one, which is right here. So going into the types of trades, there are two types of trades you can make. Responsive, which is buying this end of the profile, or selling this high, so you're going against the trend. or being initiative, which is selling the break and buying the break of the other side. What I was doing was I was buying the responsive trade in this profile with the risk of it, and I was also buying kind of an initiative slash responsive trade because I was looking for it to go initiative here, but I was buying against the overall downtrend. So remember this, I had the risk of about 15 cents or $150, but I had the reward of potentially 500, 1,000, and it goes on. Really, your minimum target is the high volume node of the profile, so your minimum target was 800. That's about 5 to 1. So that means you could have four losing trades in a row and have one winning trade, which will put you on the winning scale. That takes a lot of emotion out of trading. I'll give another example. In gold here, I bought, and really this is a real trade, and I still have it marked actually. You can see this red line I drew right there. I bought this right here. And I didn't have to be a magician to do that. All I knew was that we had an unfair high here and an unfair low here. Gold was overall in an uptrend, which you can see by value building higher. So you want to be a buyer either way, either the break of this or a buyer down here. All I had was a stop down here of about $100, 1 point, but my potential reward was 69, which is about 500 and higher. A lot of traders, they trade in these random areas, and that's what gets them killed. The risk to reward in these random areas are terrible. They're usually 1 to 1 or even worse. But when you're trading at extremes, here and here, the risk to reward increases, and that's what really auction market theory is about. So let's go back to this again and go over the trades you can make. You can either take the responsive trade. Oh shoot, let's use this. The responsive trade, which is the sell here or the buy here, or you could take the initiative trade, which is the buy up here and the sell down here, or breakout trades. Your stops for breakout trades are usually just above the low volume here, and for responsive trades just above the high here or there. But your potentials is for the initiative trade is the length of this profile in that direction, or responsive, the length of the profile in that direction when taking it at the lower extreme, and vice versa for the top extreme. The ideal trade in auction market theory are the ones where, let's say you buy it at this X that I'm drawing right here, where you first have it as responsive, but the market continues to go higher, and where it breaks out and turns initiative. Those are the trades that are going to make your account explode literally by 20%. And same on the other side, where you short it near the high and you have a break low. Like, think about it. Let's say your goal is to catch the high of the day. You could try 4 times at, let's say in gold, at this extreme. Let's say this was the extreme, it stops you out. Try it again here, it stops you out. You try it again here, it stops you out. Try it again here. You've probably accumulated, 3 losses of maybe $120. So that's a good, 360 to 400. But one trade is going to make that all back. And think about it. When you're entering short here, you're going to hold in until something says get out. And that is indicated by a bounce area forming higher. So you could see, balance kept forming lower. Nothing was saying sell until this thing broke right here. So you want to be taking it off in around this area. So that's how much? 1,200 when you lost 400. So you're up 800. And that's how you make your money. You're gonna have more losing trades in the beginning, and then big winners that wipe it all out and give you a lot more money in return. And once you increase your knowledge about the market and your feel, you'll be getting more winners, and that's going to increase your profits even more. So that's the key, really the key to trading properly. Like, in the long run, you're not going to make money risking 50 to make 50. You have to be risking less than you make. A regular trade you're going to get is ones where you risk 50 to make 250, and then you will find some where you risk 50 to make 1,000. And those are the trades that are going to make your day. So thank you for watching this video. All my videos will now be in HD. Thank you.
From billionaires.
If you are running a business where you are the one who's managing operations, sales.
There we go. Okay. Okay, guys, what I drew is the market. Every market. I don't care if you're auctioning tomatoes, coffee, wheat, cattle, stock market. It all is relative to this. This is all you need to understand. This is every MBA program after this, not worth it. Trust me. We have what's called imbalance. We have balance. Imbalance, balance, balance. Okay, this is the auction market theory. I don't care if it's art auction, wine auction, Japanese fish market auction, everything, car auction, stock auction market theory, all auctions. The market is an auctioning system, meaning for every buyer, there is a seller, there is another side. You have to have the other side in order to create a sale. HVN, high volume node. This is on the right-hand side, this is your volume profile. These curves here, that is your standard deviation. Standard deviation, this is your mean. These are your two standard deviations outside of. It's also your LVN, low volume node. High volume node, you have a low volume node within your auction market theory. What does an auctioneer do? An auctioneer advertises price, the grocery market, your Apple store, anything. Always seeking your highest, or in a capitalist society, we're always seeking your highest bidder because your underlying components are always, your input is always increasing. Well, you have components, you have commodity components, you have labor components, you have insurance components, you have lawsuit components, you have all kinds of different components. It's called inflation. You always have inflation. If you don't have inflation, you have Japan. Look how much, remember the telephones? Yeah, okay, sure. Yeah, the telephones, when they first come out, you know, they were, what, $1,000? Now they're $499. But that's all relative, right? You used to be able to pick up a phone at Radio Shack for $10 and make a phone call. The theory is that if your input is always increasing, you must always be looking to advertise and seek new prices. Otherwise, we would just sit here in a big HVN. We would sit there in balance. Fair market value is within balance. That's where we are right now in the market. We're leaking outside of fair market value. Imbalance here. See this imbalance? Balance. This whole five-day volume profile. This whole three. That's balance. That's accepted price. Who bought in here? Who bought in here? Besides the people that don't know what they're doing. But what was CNBC doing this morning? What was the GDP number trying to do? Advertise. Trying to advertise to see if they can get higher prices in the market. Once that price is rejected, you come back in and you find the next level of acceptance. Rejected, acceptance. Rejected, acceptance. It will continue to rotate between balance, imbalance. Acceptance, fair value. Imbalance is also inefficient prices. It's also advertising. You're advertising this here in this situation right here. And I'm going to go back to the iPad Mini. You're a store full of inventory. You just got bad news that the iPad Mini wasn't all that it's cracked up to be. There's some defaults in it. You got to send it back for whatever reason. It's not going to sell. It's great. It's not going to be a big, crowd pleaser. Oh, you know what? Oh, we found out that the demand is really high, but Apple can't produce them. Guess what? Markdown, price, advertise, 24 hours only, flash sale, 2 for 1. Come now, buy a PC and we'll give you one. You're advertising to sell your inventory. Then you have a new inventory. You have bigger inventory, smaller inventory. You still have inventory. What do you have to do now? Oh, they came out with a fix. Okay, great. Now the demand picks up. Auction. There's a balance. You auction out. You auction out of this balance, imbalance. You create hype. You create excitement. You create buzz. This weekend only. Living social deal. Whatever. And you come into a balance. So that's what auction market theory is. It advertises. You advertise prices and you create balance and imbalance. That's what the volume shows. This is the median. This is the value. This is the value. Then on top of that, you have 3 areas within a balance area that you can trade. Just because you're in here doesn't mean you can't trade. But you can trade the outliers. You have the outliers. Value area, low. This is a lower range of the value. higher value, low. This is a higher value of that range. Median. This is the average. The volume weighted average price. This is the average of what everybody's paying within this range. So what happens? What happens if you're in here and you come like this? What happens? What do you want to do? Do you want to be a seller or do you want to be a buyer? This is exactly what happened this morning. They start to advertise. What happens? Reject. Where does it go now? Back into balance. Guess what? This little, let's call it a shakeout, is a failed auction. A failed auction you will reject back into where it came from. That is a previous balance area. If you come back up into the previous balance, you have an 80% chance, 80% chance that you will now go to the other side. You will test the other side of the range. What is this? This is a high, this is the value area high, VAH, VAL. Is that not what the market's doing right now? Remember, it's an auction market. Everything in life does the same thing. Everything. I don't care if I just drew. Guess what I could have just drawn right there? Carrying capacity. Carrying capacity of a enclosed farm full of rabbits and carrots. It's a cycle of life. This is the cycle of life, which is also called 618 or golden ratio. This is life right here. I don't care if we're talking about a human being. Same thing. It all is relative and it's all encompassing. That means a good trade to buy in the low of the market profile is up. Absolutely. When you are in balance. Okay, so let's say that this tests value area high. Okay, that tests the value area high. Now what? What are you going to do? Are you going to buy right here? Do you buy right here? You wait for acceptance. You wait for rejection. You wait for the auctioneer to start advertising prices higher. You want to buy, you want to find, we're here right now. Okay, where do you want to buy? Do you want to buy as soon as we cross? Some people will. Absolutely. But then what happens if you just top ticked? What happened if you're top tick? We had a guy on the floor. His name is Tommy. We called him top tick Tommy. This guy, no matter what, it could not. He top ticked everything. It was hilarious. If Tommy was buying, we were selling. If Tommy was selling, we were buying. It was hilarious. Top tick Tommy. We're gonna go back to. So how do you know where to buy if you come outside? Relative price. Where do you get your relative price from? The last area of fairness, of fair value. Let's draw this out. That extends out into eternity. That extends out into eternity. Guess where you're going to buy? Where are you going to buy based on the fact that if you enter into a value area, you have an 80% chance. You're going to wait until you buy. You're going to wait until this is a no-buy zone. Right here. No-buy zone. Because the probabilities are against you. You don't know what direction this is going. You don't know if you're going to be top tick. Last thing I want to do is be top tick. That's for rookies. And remember, this is a professional game. You want to buy right in here. Value area low of the previous balance, fair value area. Okay? Because then what? What happens then? Then everybody starts to say, oh, wait a minute. That Apple iPod Mini did get fixed, and it's all good now. It's great. I want one. Well, okay, here. Let me sell you one. Well, you only have so much inventory, right? So, and the costs are increasing. I just had to advertise. I just had to pay more out of my margin. So, you're going to be a buy here. You get 80% chance you're going to check this level, right? Then maybe the stores will run out. Maybe they can't keep it in stock. They can't make it fast enough. Maybe there's a flood in Thailand, and the manufacturers of the semiconductor chips had to shut down. Maybe one of the boats hit an iceberg on the way over. Who knows? A typhoon. You got it. You got the idea, right? That's it.
When you want to speak in English fluently, you guys think that this is the method, right? Newspapers karo, endless YouTube videos.
Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we've got Rob Mitchell here to talk about auction market theory and trading with value. Rob's been trading for about 30 years. He is a trader that relies on volume analysis to pinpoint support and resistance and key areas to trade from in the market. He has won the World Cup Advisor Trading Championship, and he created his own CTA group, Creative Capital Management, back in April '99. The topics for today include auction market theory, just a general overview and discussion, specifically how to determine value from the marketplace, and understanding market context, understanding what these support and resistance lines mean when viewed in context, and also creating a daily trading plan to trade from. Matt from Optimus Futures is also here today, and it's because of Matt that we have been introduced to Rob Mitchell. So before we get started with Rob, I'm going to very briefly turn things over to Matt at Optimus Futures. He's going to give you a quick overview of what services Optimus provides and answer any questions that you have from Optimus, and then we'll turn things over to Rob. As you guys have questions, type them into the questions box. We'll do our best to get everyone's questions answered today, and I will also post the recording for this webinar on the site sometime tomorrow. Thanks, guys. Give me 1 second, and I'll turn things over to Matt.
We can have an indication if if you guys can hear me.
We can hear you, and we see your Internet Explorer window.
Okay. All right. So I'll just open the main thing. This is our main screen. So everybody go just focus on that. Okay. So Mike, thank you for bringing me here. And I just want to thank everybody on the forum. I enjoy interacting with you, and I always thank Mike for running one of the most courteous and most informative forums out there. I mean, I'm just astonished that I've seen forums over the years. I've never seen anything that grew like that, and such friendship has developed between people, forums, and traders, really and sincerely trying to help one another. I wanted to bring you Rob today before I talk about Rithmic. Rob is one of my dearest friends in this industry. Had a lot of influence on the way I think, and believe it or not, had a lot of influence on the way I also run my brokerage and the philosophy that I have behind this brokerage as far as margins and commissions, and how we treat people and so forth. And talking to him about markets is probably one of the more intelligent conversations that I have out there with third-party vendors. So you'll enjoy him very much. Just to tell you a little bit about Optimus Trading Group, we're basically a discount brokerage firm. This is where a majority of our business goes, probably 80%. The rest, we also execute systems for people. We execute commodity trading advisors, business here as well, people who are have shown that they have a track record and so forth. They use our execution services. At Optimus, because we have a very good and organized user visual. I make my decisions. You know, I don't do business with companies. I do business with people. I avoided Refco, I avoided MF Global, and I avoided PFG, and I went through all the scandals. So I was solicited by just everybody in the industry. What I like to know is the owners of the FCM, how they behave, if they're responsible, how fiscally they behave towards risk, how they assess risk, do they have proprietary trading, do they try to run a lot of businesses outside of the FCM that could have impact. And in general, believe it or not, I look at the lifestyle that they have. So this is the one thing that it's important to me as far as the individuals that I do business with. I think personality plays a big role in who you choose to do business with. And Mike, to be honest with you, your forum is great for that because, you know, there's enough information there for people to really make decisions of who is behind the scenes of those companies. It's pretty transparent, and people discuss it and they share the information out there. So that's the one thing I would do, you know, not just look at CFTC and NFA records, but really look behind the scene who's running those companies, they have prop desks, their personalities, how long they've been in business, and so forth.
Right.
So that's
okay. Thank you.
In a nutshell. That's
right. Thank you for that. So if anybody has any further questions for Matt, then the website is optimusfutures.com, and you can send him an email at matt@optimusfutures.com. All right, so thanks, Matt. We'll let you go. I can see your phone. Your phone's literally ringing off the hook. So give me one second.
God it does.
Give me a second. I'll turn things over to Rob. Hang on, guys. Rob?
For me to speak today, I kind of was holding myself back from saying some things about Matt. Matt and I, as he said, have known each other for many years, and Matt's just a really good guy. I can sum it up that way, and he works for what I see to be a very solid firm as well. So without further delay, let's get into the presentation because I have a lot to talk about, a lot of slides to cover, and we'll have a Q&A session at the end. And so if you have any questions for me, fire away at the end, but I'll try and get through this quickly so we have plenty of time for that. Before going any further, the CFTC disclaimer: past performance is not necessarily indicative of future results. There's a risk of loss trading futures. That means you can lose more than you have in your account, and you need to be aware of those things when you open an account. So one thing that I always like to talk up front, it's probably an over-discussed subject, but is trader psychology. And I bring this up at first because it's at the core of what I believe is an effective approach to trading. And I hit it maybe a little differently than other people might talk about. But if you learn from people who are great in sports or acting, for example, you'll find that they practice their craft to the point that they can do it without having any rational thought. And the idea is to get that rational mind out of the way. And, you know, when you put a 70-millimeter camera 6 inches from somebody's face and if even the slightest little twitch or flinch in their eye just totally gets in the way, or many of us are more familiar with sports. You know, if you're playing basketball and you have any doubt as you go to make that layup, you know, you're probably going to fumble it somehow. And so, because the rational mind comes in and starts analyzing things, and it's very paralyzing for many people. And so, to trade successfully as a discretionary trader, not as somebody who's firing through TradeStation, as Mike and Matt were just discussing, to a FCM, but if you are trading on a discretionary basis throughout the day, and that's pretty much what we're going to be talking about today, then you're really in a much better position to get that rational thinking out of your way. And the way that you do this is you become so familiar with what it is you are doing that you can kind of throw it in the trash and let yourself just act naturally, and so and intuitively. And so I'm a musician. I've studied bass for many years, and I've been a classical guitar player. And a teacher that I have right now told me about a theory of learning, and he said that when you're under stress, you always reduce to first learned behaviors. And what this means is that if you learn, in the case of music, if you learn to play that piece of music incorrectly from the beginning, you don't practice it in time, and you approach it in a sloppy manner, then when you come under stress, when you walk out on that stage and you look out there and there's 3,000 people out there, you will naturally reduce to your first learned behavior, which is the bad way of playing it. You learned it wrong in the first place, and then you overcame that and relearned it correctly. And then when you walk out on the stage, you go all the way back to the learning it wrong. And that's why I bring this up. If you can learn things right from the beginning and approach everything correctly from the beginning, then it frees you to be much stronger when you come under stress. Because the second you click that button, you're not on a sim trader. You're really dealing with a whole different animal. And so you may be able to behave one way while you're sim trading, and then as soon as you have $500 on the line or $750 or whatever it might be today for the lots you're trading and the stops you're using, you suddenly are back to some really bad habit. And so it's important to learn things right from the beginning. And so I try to approach things structurally as we go through this webinar that will be what I believe is that structure that can give you the foundation in terms of market auction theory. So I'd like to talk about a story about an art auction, and I believe in one of James Dalton books. James Dalton are probably some of the best books on this subject, but I believe the second one, Markets in Profile, he talked about this briefly, but it's a very instructive point of looking at just exactly what is the market doing as it's going up and down and alternating during the day. And essentially what you have is an auction, but it's a continuous auction. So we can simplify that idea a little bit by talking simply about like an art auction for, let's say, just a painting. And let's say you have this painting for sale, and it's a very famous painting or something, and you have 50 people come into the auction. And the reason these 50 people showed up at the auction is because they believed that the opening bid for that was a fair price or a good deal, probably more likely a good deal. And so what happens is they open bidding, say, at $100, and then at that point in time, everybody in the room agrees that it's worth $100, and the auctioneer then says, do I hear 110? And someone raises their hand, yes, I'll pay 110 for that, and then, you know, it goes up a little more, and next thing you know, you're at 130, and at which point, certain people in this group of 50 people, this closed audience of 50 people, start saying, well, I'm not paying $130 for that thing. I mean, I thought, you know, I came in here thinking if I could get it for 120, that would be pretty good. And so what happens is, you know, 3 or 4 people now drop off. They're no longer going to participate. They've decided it's not worth it. And then up it goes a little more, higher and higher, 150, 180, 200, you know, who knows, sky's the limit. And then something amazing happens. There's one person remaining in the room who wins the auction. And at that point in time, what is happening is there is 49 people in the room that think that the price is absolutely absurd. And there is one person in the room who bought it and is probably having some kind of buyer's remorse at that point. Oh my goodness, what did I do here? I just paid, you know, all this money for this painting. And, you know, I mean, the other people in the room might even be chuckling, what an idiot, you know. And so in the market, that would correspond with the high or the low of the day. In the market, that auction can go down. That would be a reverse auction where you'd start at, say, $100 and work it all the way down to $10 because nobody was interested in it at the initial bid of $100. And so there's a continual evolving auction when we start doing this in the S&P or the Russell or whatever market we might do. So when that last person makes that purchase out of the 50, the one out of the 50, there's officially at that point 98% of the population there agrees that the painting is not worth what it sold for. And so this inspires a couple of interesting things. If you know that you can sell, let's say that the painting that is selling in this auction is duplicable, then what would happen is those with a little bit of ingenuity would start thinking, well, you know, if people will pay that crazy amount for that painting, then I'm going to set up shop and go in business for myself, and I'm going to sell these things. I'm going to open up a art gallery, and I'm going to sell these things if people are willing to pay that kind of money. Now, of course, we're out in the extreme of a curve here, and so it's really not worth that amount, but there are cases where we see, you know, a real estate bubble. We all went through this, that we know that prices will just continue climbing without any rational thing, and it's usually driven by some other thing, like a lot of available money or something of this nature. Anyways, I just wanted to open up this idea about what an auction really is and what kinds of psychology and statistics are behind this. And because auction theory is really nothing more than what you learn in a Statistics 101 course. It's really looking at price distributions and probabilities within those distributions. And typically these things are shown on a screen, and I will go to this next slide and we'll talk about what these things look like on a screen for those who might not know. There's a couple of ways that you can look at them, and the one I'm going to focus on today is volume at price. And what this means is for any given tick, the S&P there's 4 ticks per point, and the Russell there's 10 ticks per point. For each one of those ticks, what we're going to do is, over a given period of time looking back, we're going to accumulate the ticks for each one of those prices, the volume at each one of those prices. So in the case of our art auction, that very top high that the painting sold for, there's a 1 lot that ultimately sold at that price. What will happen is, as you move back towards the price where people might have had more agreement as to what the value was, that it was trading at a fair value, then at that point there will be more volume at that point. And what you end up with on many days, and today is an example of this, is you end up with what's called a bell curve distribution. And so that is where the high and low of the day have low volume, and then the price of the day closes somewhere in the central part of that range between that high and the low, and the distribution is curved around that. It's evenly distributed around that point. And when you get this kind of a distribution, what it means is that there's agreement about the pricing at that central tendency, and that would be called an average price. And so what happens is, because that volume is very high in the center of that curve, that means the majority of it agrees on that pricing, and that is what we call value. There's a difference between the value and the pricing that occurs, and the example of that is anybody who goes out to shop a deal, there's a difference between value and price. The price is what it's being advertised for. Price is simply an advertisement. And in auction theory, we say that price moves lower in search of buyers, and it moves higher in search of sellers. And so the actual value is what the collective population who may be participating in that price believe is a fair value, whereas the price is what it's selling at or trading at right now. And so this auction theory, this use of statistics to analyze where the price is trading in time, enables us to establish where the majority of participants likely see as a fair pricing right now in the very recent past. And so once we have that all figured out, then we don't really have it, it's not mysterious any longer. We now understand we're just dealing with a distribution. And I think if I can pull this up on the screen, I'll just draw this. Okay, I guess it won't. I don't know how to draw this, but if I just simply show, let's say this day 7-11 right here, because I don't have today's on.
Rob, you can draw if you want. On the left of the GoToWebinar, there's little icons. The bottom icon is drawing tools. You can use that if you want.
Let's see, on the bottom left.
There's little bitty icons that are off to the side of the panel, and the bottom one is drawing tools.
Oh, cool. Okay, yeah, thank you. Okay, I'm just going to draw right on here. And so if we have, can you guys see that all right?
Yes.
See my funny little drawing up there? Can you guys see that? Okay. If this is the price region that we're talking about, if I look at this bottom little pivot right here, that's going to be if I just draw a box around this, and I'm going to analyze the volume inside this, what I know is that down at this low one, I just have one unit of volume right there. And as I go higher, I'm going to pick up 2 because I've got the V right there, and so I'll have a little bit more volume. And then as I get up to here, I'm going to start picking up this point, this V, so I'll have 3 points of volume. And then as I get here, I'm going to have 4, 1, 2, 3, 4 going across. I'm going to have another one there. And then as I get up in here, I'm going to end up having the volume is going to kind of be like this. And because this has all this volume up on top, I'm going to end up with a distribution that's kind of like this. And so it's going to be kind of somewhat of a P-shaped. And we'll talk about the shapes in a little bit. But that's essentially what it's doing, is just plotting the volume at each one of these ticks throughout this this period of time that I have on there. And so there are several different shapes that you get. Now I'm going to go over those with you. I'm going to go over those with you in a little while. So let's continue on to our next slide, if I can figure out how to turn the. Here we go. Let me see if now I got to figure out how to turn it back off.
Does escape work?
Mike. Oh, let me try escape. All right. Thanks for bearing with me on the newbie on the Citrix system. Okay, here we go, guys. We'll get to this next slide. So what we have here is a distribution like what I've been talking about over the past several minutes over each day. And so what it's doing is inside of each one of these days, it's drawing the distribution price, volume at price for each one of these. And then these upper and lower bands that we have on here are the what are called the value area high and the value area low. And I think I'm going to get to that in a minute. So let's get to areas of interest in terms. What the volume profile chart is doing is it's taking a statistical viewpoint of price distribution, and then the dashed cyan lines above and the dashed coral lines below and the value area high and low are called VAH and VAL respectively. These are terms you will commonly see with people who do this kind of analysis: value area low, value area high, and point of control. We'll get to that in a minute. But these levels on these particular charts, the way I have them set up, is to contain 70% of all trading that occurred. Now this 70% level, you'd also learn this in a statistics 101 course, is, well, 66% is one standard deviation, contains about 67% or so of all cases. And then as you go out to the higher part of that distribution I drew on there a minute ago, you get into the second standard deviation. That holds another, I think, 30% or so, and then the last one is about 90% of all the cases for that particular distribution. So if we go to this, there are coral lines below, coral below, and blue above, and what that's showing is the price, the value area for this particular day for the 17th, these two right here. And then this line in the middle is the point of control, and the point of control is where the most volume was for that day. Sometimes you'll see point of control called the POC. And so that is considered to be fair value for that particular day, that point of control. And the zone in between is considered to be the value area. And so I'll get into more in a minute on how we use this. In between the value area high and value area low is another line called the point of control. And the point of control is the level at which the most trading took place on a chart for the relevant interval. And in most cases, the POC is an area where there is or has been some agreement about pricing. And this may also be called a high volume node, HVN, and which just means that's the highest point. There are also areas of low volume, and these are areas where there is no consensus about pricing. And this may be called a low volume node. Let's see if, well, we'll get to the low volume and high volume nodes in a little bit because this is really, this concept here, high volume and low volume, is really the key of what I want to show you today in this presentation, because it's really everything. But we'll get to that in a minute. Prices tend to move between areas of high volume agreement and low volume disagreement. Again, I'll reiterate, the high volume was where the majority of that art auction crowd agreed that pricing was fair, and that represents value. And so that's the high volume. The low volume, where that last guy traded, the high of the day, that represents disagreement. Prices will tend to move with little resistance through areas of low volume and with resistance in areas of high volume. This is a very important concept because it can tell you if a breakout is valid or not. If I have a breakout setting up on a chart and I know on my profile that there's nothing but low volume behind it, then I know that price can very freely and very quickly move through that region. And so I will try to trade in areas of breakouts into low volume because I want that price to move like crazy away from my entry. And so we'll get into more detail about this as we go forward. I want to continue, and I don't want to get too far behind the curve here on the timing. So auction price movement. In areas of high volume, prices will tend to congest or consolidate, and we can make predictions about price action based on the analysis of these areas. Let's take a look. Here we have a composite, and this is actually very close to what I have on my screen today, but it's changed a little bit. But what we have here essentially is, if I look at this, we came up into this high volume, we were up in this high volume node right here, and then note what we did through this low volume region right here. We gap, boom. So overnight, it just, and then it opens up in higher volume. So it goes from high volume to high volume, just overnight, boom, right there. You can see this high bump here. And then it drifts around in this high volume area, because high volume is a price attractor. And then we come into this next day, and we start seeking value elsewhere. We probably had a report on this day. I don't remember that far back. And what do? We seek through, and we find almost the very lowest volume area on the whole volume chart here. We come down into here, the lowest volume area, and then we come back up and we seek back into high value again. And so this is the principle, is that you move towards high volume, and you tend to get rejection in low volume where there is not agreement about price. What makes markets consolidate or trend? When a market is in consolidation or high volume, it's in agreement about valuation and is often waiting for new information before shifting modes. When a market is in a trend, there is not agreement about valuation, so it seeks new pricing and new value. And so discerning these environments is a big part for me of trading profitably, is discerning where these volume areas are and what the market is likely to do as it enters into these areas or is rejected by these areas. Rejected or accepted, depending on high or low volume. And for this reason, 35 years ago, 40 years ago, I was in real estate. They said location, location, location. You're going to be a real estate investor. Location, location, location. And so I say for trading, context, context, context. It's the same thing. When we can establish the context of the market, we know if it's likely to trend or move to new areas. And we can then turn this into an actionable plan. And this is kind of, I always want to know the context I'm trading in advance. So as the day unfolds, I know already, because I've already done the homework, I already know what is likely in the play. And I noticed that Mike, at the beginning of this presentation, it was very appropriate. He had a dollar sign on the front of the presentation. That wasn't part of my PowerPoint presentation, which looks really boring, but he had this really nice looking graphic on there. It was a dollar sign that was cut into a puzzle. And trading is very much like this. It's like solving a puzzle. And so when you know where these areas of high and low volume are and what the price action is doing, and then you can see the news reports, whether or not they're meeting or beating expectations, you can often paint a very clear picture of what is likely to happen. And then it's just a matter of getting a position on with a manageable stop for the reward you think you might be working with. And so price versus value, what's the most important price of the day? I always like to ask this. And the answer is it's the open. The first question I'm asking myself each morning when I come in the office is, are we opening in or out of value? I have a little YouTube channel that I started where I discuss the overnight price action, and I talk about where we are with respect to this whole value equation. And that's actually what I'm trying to do with this presentation, is to teach you so you can do this yourself. And actually the YouTube channel was intended to do that too, to teach how to do this overnight analysis with respect to these volume areas. And we'll get into that a little bit more. The simplest form of value analysis occurs at the open because you can easily tell if there's a change in sentiment or value. And so if we're gapping away, there's obviously been some sort of change overnight in the perceived value because we have moved away from volume. And similarly, we could be opening inside range like we did this morning, and then you get a range trading day. We'll talk about that in a minute. Value rules. If the market opens inside value, there is agreement about pricing, and the market is more likely to range. And like I said, that's exactly what happened this morning. If the market opens above value, it is bullish, and I will look to buy retracements lower. So if it comes down lower, I'm going to look to buy. Because the market opened above value, it told me that there's a change in perceived value, and if it retraces a little bit, I'll try and find a low-risk entry in that. The ones I'm giving you here are textbook kinds of strategies. I'm giving you the basics, and of course there's failures, and anything can happen. But this is the basic context that you impose, because when you create a context, you have now a basis for learning. if you don't really have a context, you're just kind of out there in no man's land. And that's really the biggest single reason that I do this sort of analysis every single day, is because it gives me a context from which to learn more about the market. And so continuing, if the market opens below value, it is bearish, and I will look to sell retracements. And if the market opens outside of yesterday's range, higher or lower, out of value, out of range, this is even stronger. This slide right here, excuse me, is the very core of a I call it the daily value report and value area report. And it's this slide right here is the very structure of that. And I will show you where you can view that each day in a little while. It's just something I put out on the internet. Buy sell areas. If we open above value, then look to buy the value area high or the point of control. So this is the retracement. So instead of using something like a moving average or something, I'm going to buy at a return to value. If we open above value, I'm going to try to buy at a return to value, either a return to the highest level of reasonable value, the value area high, or the point of control, which is the most agreed upon area of value. If we open below value, then look to sell the value area low or the point of control. So we're below it. I'm going to look to sell the most likely agreed upon value from the previous day, or the lesser of that, the value area low. But I'm going to look for it to touch that value area. And then within that larger context of that trading plan that I'm presenting on these last two slides, I want to know exactly what's going on with the news. I don't necessarily need to know what the news was, but knowing the time that the news is coming out and seeing the reaction to it within this framework of this larger context of the value area. And so I'll get to that. Hopefully we'll have a little bit of time at the end of the presentation, and I will talk about the recent price action today and yesterday, for example, if we have time. Here's a slide. Sometimes I forget how I made these, but essentially what we had here on this day, this is the value area from that previous day. Notice that day was very narrow, 2 days in a row, a very narrow price action. That was the fourth, so that gave you a really narrow one. But you have a very narrow value area here, and then what happens is the price departs away from it and trades lower. This is a textbook kind of a scenario. On this particular day, it looks like we opened in value, and then we did a strange thing. We just ranged back and forth all day, and although we did it outside of value, but it was a very tight range. We've had very tight ranges lately. It's made trading difficult. Let me see if I have another one here. Here's another one where you open below value and you just head south all day. This one you open in value. Typically you would range inside of a day like that, inside of the value area. But very often later in the afternoon you'll break a little lower. Here's a day where you open in value and you just range all day. This one you open below and it ranges. Sometimes when you gap, you just don't have the gusto. It gaps below value, below range, and you get some downside, and then it just decides to sit sideways all day. So you have to deal with each one of these cases because it doesn't always do what it's supposed to do. And so that's why you kind of watch what's going on and try to bring other information into this contextual equation that we've been talking about. On a more advanced basis, volume profile value analysis can get much more advanced. Let's look at a couple other forms of analysis. Shapes. I always like to think of myself, years and years and years ago, I owned a restaurant, and I studied with a French chef, and when I finally couldn't afford to work for him anymore, I opened my own restaurant, and I took all of this high-end French style cuisine and I reduced all of it to a process. It was kind of like McDonald's. That's what they've done. They've reduced everything they do down to the simplest steps so that they can show anybody how to do it. And it's duplicable anywhere. You have McDonald's opening all over Asia right now, for example. Very successful. Don't get me talking about McDonald's. They've paid a dividend for, I think, 34 years. Every year they raise their dividend for 34 years. I always reduce the theory to a simple to understand concept. And when you're able to get through the logic, this also happens when you write computer programs for trading things. You have to get down to the very specific logic that's making it work. And then you know when it's doing it or not doing it because you know the specific rules. it's not a fuzzy kind of idea in there. And so I had mentioned earlier there's a lot of cultism to auction theory circles, and like I said, it's really just statistics 101 applied to markets. And so they'll go on and on and on about it, and you read a 500-page book, and you can really be reduced to a couple of sentences. So that's kind of what I'm trying to do for you here. I'm just reducing these things down to the simplest terms, and that's where we get into shapes here. There are 4 basic shapes that you can have in a profile. Of course, you could come up with more of them if you want to, because it's it's kind of continuous functions. Some days it's kind of fuzzy what the shapes are, but by and large there are 4 basic shapes. You have a capital D, a little b, a p, and a big B. A D shape is what I was talking about in the beginning. We talked about a bell curve distribution. It's a normal statistical distribution when you have that, and it's evenly distributed. And I think if I go back a couple of slides, that was this day here, for example, would have been, I guess, the 5th, or this day the 6th. Those are normal distributions. It's just D-shaped. And so the next shape, let's see what else I had here. D shapes are associated with consolidation and the building of value in a region on your chart. Breakouts occur from Ds. Now, the reason that breakouts occur from Ds represent value, highly agreed upon value. And so usually for price to leave that high volume area, there has to be a change in perceived value of a large number of participants, because otherwise it wouldn't leave. They'd fade it when it hit the extremes of the D. And when they don't fade it and it breaks higher or lower, that tells you there's a change in perceived value. And if you come into that with some volume analysis, it can tell you how much gusto is behind it. And so so I asked the question, did you see any Ds in the last chart? And I went back and I cheated it for you, and we spotted a D there. The next shape is a B, and you get a B shape typically when the market sells off and then consolidates, and this is associated with long liquidation. Basically what you have is you have a sell-off, and then the market will consolidate in a range and it'll form somewhat of a B. Let me see if I can find one of those on that chart. Not really seeing one there. We have a P there. I probably have one for you up ahead. Protracted sell-offs often begin with long liquidation that is followed by new sellers entering to follow it up. And so if you do not get this, and usually you don't, then the market will retrace the B. And so Bs, textbook answer, Bs are most often retraced. And so let me talk about that a little more in depth, because I don't want to just blast over that subject, because this is also very key. Most reversals in price start with, if you sell down, for example, it starts with short covering. It's the shorts getting out of their positions. They go, holy moly, it's turning around and getting out. I don't want to go back to a break even on this trade, right? And so that will propel the market higher in this particular example. And so what happens is one of two things. Either the shorts covering will be followed by new longs propelling the market higher, or it'll get faded and new shorts will enter again. But almost invariably, a move begins with either short covering or long liquidation. And so you want to discern between, this is a discerning between old money and new money. Old money is the already existing shorts, or in the example that we're using here, and new money is new positions being established. And I think we'll talk about that a little bit more as we go on. The next shape is a P, and you typically get a P shape when the market rallies and then consolidates. This is opposite to what we just discussed with the B. This is associated with short covering, and protracted rallies often begin with short covering that is followed by new buyers. I might have just told you that other one backwards, but I think you get the idea. Protracted rallies often begin with short covering that is following new buyers entering, following it up. But you don't usually get this follow-up because markets are counter-trend oriented. So what will happen is you'll come up to the P, you'll consolidate a little bit, and then you'll get retraced. So Ps are most often reshaped when you see that shape of a distribution on your distribution software, whatever you happen to be using. So sometimes you'll get Ps or Bs that are backwards. You'll get consolidation followed by the move instead of the other way around. And I don't want to launch into a long discussion of that, but I'm just opening up your thinking about how different shapes might actually have different kinds of patterning behind them, so going deeper into the kind of thinking. And you'll do well to notice when this is occurring. I'm not going to cover that in this lecture, though. Sometimes the move is a gap followed by a consolidation, and then you get a P or a B, but it's missing the volume area, the stem of the P or the B, because it happened overnight. And so that's another pattern that is good to know. So very often gaps are examples of this. You look for clusters of volume following a gap that is followed by a reversal. I think we saw something like that this morning. The B shape, capital B, is associated with continuation. And this is a double distribution. It's kind of like a D with a little punch right in the middle of it. And so it's like putting two Ds together, one over the other. And so I mentioned that again, this is another way of expanding your thinking, because everything can really be reduced to a D in some form or another. It's a D with a stem, or it's two Ds. So everything reduces to the D, right? And what's a D? It's a normal distribution. It's agreed upon pricing. And so what happens is the market tries to find value, followed by a move that's going to look like a bull or a bear flag, and then it's going to consolidate again. Sometimes you'll have days that look like a rally day. The market, the S&P will move 20 points, and you'll see essentially three Ds on there on the distribution for the day. And the reason for that is it shoots up, it flags out, forms a D, shoots up again, flags out, forms another D, shoots up again, flags out, forms another D, and then there's no time left in the day and you end up with a triple distribution. I very rarely would see that go to 4 inside of a day. But sometimes you'll see this. And this is an intraday making of the other more basic patterns or shapes, so there are less than 1-day profiles. So you could, I know some people developing software that enables you to see these distributions inside of any box that you make on your chart. I had thought about doing this at one time, but then I came up with some other tools that made it simpler for me. There are really only two or one shape, the Ds, and price movements, and everything else can be analyzed from this viewpoint. So this goes hand in hand with the saying, calm before the storm. The D is the calm, and then the storm is when you leave that region. And as I said, if a D is agreed upon price and you come to the extremity of the D, you're most likely to get pushed back down into the center of that D, which is, as we discussed initially, the point of control. And in a lot of ways, the market is like Newton's theory of motion. Once you set it in motion, it'll continue moving. And then when it hits these areas, people will go, well, wait a minute, it's not worth that anymore, and they'll start getting more and more people agreeing that it should go back the other way, and then you got to pivot. And so markets tend to move, as mentioned, from areas of value through areas of no value quickly. Can you see how that reduces? I just described it going from D to D to D. And when we get these quick movements, we call them single prints. This is where you just get one bar going up, and then it clusters. And by the way, when you get that one bar going up, that's low volume, right? And so it can move back through those relatively quickly very often. That can be a trap, bull trap or bear trap. Single prints are when the market moves. through an area quickly and leaves a thin profile. Remember, areas of low volume should provide rejection and areas of high volume acceptance. You could even call a high volume area a magnet and a low volume area is a detractor or something that pushes price away. Value area relationships. You then get into value area from one day to the next, could be higher or lower or overlapping. And in the reports that I do daily that I'll show you what site those are on, I talk about that inside the report because this can be used as a trend indicator. If you have value areas going progressively higher, sometimes they even gap away like they did yesterday. The whole value area is gapped away from the previous day. They can also be narrower or wider. And so when you have a really narrow distribution, if you get a D and it's really narrow, you're talking about consolidation that's very tight, and you break out from those ranges more easily than you do a wider one. In fact, when you get wider areas, it tends to be more of a market that's ranging and just freely auctioning, and you get these wide value areas, and so you get that kind of a tendency. And I don't think I really talk about that much more, but I do talk about it in the report, and like I said, that's the learning aid that continues after this webinar, which is kind of cool. Composites. So far we've been looking at value on a day-by-day basis. We can discern a bigger picture by making composites. Composites are when we join multiple days of volume into one profile. So this makes it easier to see the high volume and the low volume nodes that we talked about initially that can be attractors or detractors, as the case may be of price action. And this is an example of a composite. And as I had mentioned, this might be the same chart. Yeah, we gap through this low volume area. We open that day into higher area, and then we take our time kind of drifting through that for a couple of days. We make our way lower. We test into a low volume node, and then we come back up right into that value area again. So this is kind of a what we'd have a stem and a B here, and then it breaks lower, another stem and a little bit of a B, and then we finally retrace. That one, of course, failed. But I had mentioned, you kind of need to know what's going on with the news with all this stuff. 10 years ago, I would have said, oh, I never look at news. And then nowadays, the whole economy is driven by the government. And so you really kind of need to know what's going on the news front, particularly scheduled government reports. Composites are great for doing support and resistance work that provide a larger contextualization of market action. And we always want to trade on a level lower than our lowest level of analysis. This is an interesting principle. We always want to trade on a lower level than our lowest level of analysis. So I want to be trading, 3-minute charts when I'm doing analysis on day charts, for example. I'm just throwing that out there, not necessarily any magic there, but composites are part of this. So I always know what's going on. I always have a composite on my screen because it reminds me of where I am in a bigger picture. One of the problems that we get into as intraday traders is we get so caught up in the minutia. You find yourself trading on a 3-minute chart intraday, and the range over the last hour has been 1 point, and you're in there trying to take something out of it. And geez, what a formula for getting eaten up, as many of you may be nodding your heads. So I keep these shots on my screen to kind of remind me of what these ranges are and everything else, because I tend to, for just my own personal trading, I tend to trade very tight, very quick. I want action now and I want out. And so that's just my personality. And so others are more patient and can get in a trend trade, a day like yesterday to pick up 15, 20 points. That'll never happen to me, at least not the way I trade right now. I see it, but I don't do it because I can't stand to sit there. I want to be done by 8:30 in the morning my time and start trading at 6:30. So as I get older, I don't have the energy and other things. So you find what works for you within these contexts. So you're trading, you're looking at 30-minute charts. I even have 720-minute charts I look at. 1440 is a whole day, 720, 360, then I go to 250, 50-minute chart, 25, 10-minute charts, 5-minute charts, 2-minute charts. And so I have ways of reducing that all down onto one screen, but, trying to keep myself in that larger context so I don't do stupid stuff, Okay, what did you notice from the composite? First off, you should have immediately noticed the high and low volume areas. And then did you see we had formed some value at or about the current level? And let me see what that might have been. Yeah, we're forming value in this current level. This is the high volume node on the chart, but this is a secondary one for sure. And we've definitely over the last number of days been working on that region. I think then we broke, we're at 766 now. So we're actually back, we came back down and visited this high volume area. And then we bounced off of that yesterday at the low. We actually came right down through this high volume a little bit, and then we bounced back up. I apologize if that wasn't a bit more current, but we had some time getting the webinar prepared for you, et cetera. So, these numbers are probably not going to be right, but I think we've kind of covered that. Here you can see on this particular composite, and this is from a number of months ago, we get all this clustering in the high volume area. We came down very quickly through that low volume area, and then we clustered at the high volume area, and then bam, we go really quickly through the low volume area again. So when I'm trading intraday, I'm asking myself the same question. We were looking at this on multi-day scale. We're looking at it on day scale. I'm asking myself intraday as the price is clustering after making a move or something, whether or not I have low volume. If we came up into the cluster area, I'm asking myself if we have low volume below it that we can quickly move through. Because when that breaks, I want to be in that trade where it has the potential for moving quickly. Otherwise, it clusters there, and you don't get the movement. So I have a blog, markettradersjournal.com. And I do this value area report on there each day for you. And the reason I put that there is as a learning tool, because it covers everything that we're talking about here. I talk about the shape, I talk about the width, I talk about whether it's going higher or lower, whether the value areas are trending. I talk about what the value areas are. I talk about things such as virgin points of control, which we didn't talk about in this webinar. A virgin point of control is kind of like a gap. It's a point of control where the price departed from it, and very often these are magnet prices later on, and the price will move back into that. And so there are many articles. I talk about what the value areas are. I talk about things such as virgin points of control, which we didn't talk about in this webinar. A virgin point of control is kind of like a gap. It's a point of control where the price departed from it, and very often these are magnet prices later on, and the price will move back into that. And so there are many articles. Over the last 8 months, I've probably written 50 articles on all different kinds of topics on that blog. and I've really poured a lot of my heart and soul into it. And there's just a crazy. I went on vacation a few weeks ago, and I came back, and I just couldn't even begin to muster the kind of energy that I was putting into it before I may be able to come back to that level. But I was writing pretty much every day, and different things, and working on different subjects. But they're there for your reading, and it covers a broad overview of using different kinds of volume techniques and auction techniques. And so so you can read the articles. There's more there on this actually quite a bit, because this has really been a big topic for me, what this webinar is on. And so there's a lot more material there talking about little nuances and whatnot of using this. I think in a lot of ways it's easy to get trapped into over-analysis, and that's why I talked about that at the beginning. This stuff really shouldn't be that complicated. For me, I've devoted my life to coding systems and analyzing things and writing things about it. And for somebody just coming into this and learning these things in the simplest possible way, like I try to present, then you don't carry all this extra baggage that when you're entering a trade that you carry with you. And so there's really a lot of advantages to coming into this fairly fresh and having somebody to have gone over some of this with you. But I see there are some followings of this sort of thing that just get, it almost gets like, religious kind of appeal to it. And I try to not hit it at that level, so just try to turn it into the statistical thing that it is. I have a background in experimental design and statistics, so it's natural for me. When I first saw this, I was like, well, wait, this is just statistics in applied statistics. So so after reading and studying on the blog, or going over this webinar, Mike's recording this, which is really nice. If you have any questions, by all means, ask me. I've put a forum on the blog there, and so if you have any specific questions, or you can ask it within Mike's, we'll try and get some answers on there for you if you post there. I also have a Twitter feed, and I post some of these things on that during the day. I have that kind of automated.
We have a lot of.
That's what I have.
Great. We have a lot of questions coming in as well.
Okay. I hope I hadn't gone too. After videos, I know I went full stream. Going back.
That you say, opening out of value. What are you using to define value? Are you using it just the prior day, or are you looking at, 2 or 3 days that are imbalanced?
Yeah, you're actually giving me goosebumps, Mike, because what you just described is a really, if you have the patience, I'm like a bit of an adrenaline junkie or something, but what I look for, what I like to see, is exactly what you described, a couple days of D distributions. And if that second D is inside the first one, that's even better. Of course, a lot of times when these scenarios that you describe occur, it actually
सर इंट्राडे में मेरा या तो हर बार ऐसे लेट होता है या तो एंट्री गलत होती है मेरे को ऐसा
Well, hey everybody, my name is Mike Baltos, and welcome to this presentation on order flow trading made easy. And these markets nowadays are very all over the place. Cost close to $2,500 a month, and I had order flow software to help read the order flow, but it was just a basic software, and I wanted the software to do more for me, right? Because that's customer may have orders that are being traded in the market. When an order hits the market and it trades on the exchange, it gets posted, right? You can see that data come through on your computer. Now, if you're looking at a normal candlestick chart, right? You just hear your regular everyday candlestick chart. Some people think it's the greatest chart ever because, I can see the open, I can see the high, the low, the close. I can see the relationship between the open and the close, and I can make a decision from there. Well, that's all well and good, maybe 100 years ago. But why limit yourself? Okay, the volume footprint chart, yeah, it shows you the open, high, low, close, but you can see the volume that's traded on the bid, volume traded on the offer. You can see where there's buying imbalance, where there's selling imbalance. You can see where traders are defending a price. You can see where traders are being more aggressive. You can see where price is being exhausted, and so much more that you're not going to see on just a normal candlestick chart. Now, most traders, when they hear the term order flow, they think of the DOM, right? Depth of market price ladder. And the difference between the DOM and a volume footprint chart is the DOM just shows you the working orders. It shows you what's on the bid, what's below the bid, the next bid below that, what's on the offer, the next offer, the next offer. The footprint chart records what's traded in the DOM, and it'll put it on a chart. Okay, so you can see, how much traded on the bid at 33.39 and a quarter, how much traded on the offer at 39.39 and a half, or what traded at 39.39 and a quarter versus 39.39 even. Now, if you look at a normal candlestick chart, you don't even see the volume, right? You're just looking at where the low is, where the open is, the high, and the close. Now, order flow is really about understanding what the aggressive traders are doing in the market. Now, if you don't understand what aggressive traders are, think of it this way. In the market, there are passive traders and there are aggressive traders. Passive traders are people that are either trying to buy on the bid or sell on the offer. They're waiting for price to come to them. But for a trade to happen, someone has to get aggressive. Let's say the market is 33.39 bid and 33.39 quarter offer. 78 on the bid, 98 on the offer. For a trade to happen, either one of the passive buyers there at 39.39 has to be aggressive and buy one from a seller at 39.25, or for a trade to happen as well, either someone that's trying to sell it at 39.25 got to say, you know what, I think this market's going to go lower, I don't want to miss it. They got to lower their bid to 39.39. They're going to be aggressive. So just remember, aggressive sellers sell to passive buyers, and aggressive buyers buy from passive sellers. The way to think of it is, you want to buy a car, okay? You want to buy a, the new Corvette, and you go to the dealer to sell, or for a trade to happen as well, either someone that's trying to sell it at 39.25 got to say, you know what, I think this market's going to go lower, I don't want to miss it. They got to lower their bid to 39.39. They're going to be aggressive. So just remember, aggressive sellers sell to passive buyers, and aggressive buyers buy from passive sellers. The way to think of it is, you want to buy a car, okay? You want to buy a, the new Corvette, and you go to the dealer, you see he's got one there for $65,000. You think, I don't want to pay $65,000, I'll bid $60,000. Well, he wants to sell it at $65,000. So you guys, no trade's going to happen unless one of you is going to get aggressive. The dealer may think, oh gosh, I got a truckload of these Corvettes coming in next week. Fine, I'll sell it to you at $60,000. And he got aggressive, he sold it. Now, if you're going to be the aggressive buyer, think, gosh, I really want this car because I got a hot date later this week and I want to impress the girl. So you're going to go buy it. You're going to take $65,000. Okay, you become the aggressive buyer. So remember, aggressive buyers buy from passive sellers. Aggressive sellers sell to passive buyers. Now, candlesticks charts, right? They leave out a lot of information. The footprint chart has that information, but if you like your candlesticks, you can keep them because you can have on your chart still your candlestick. But you can see, the candlestick chart has, the volume, what's traded on the bid, what's traded on the offer, where the market's showing aggressive buying, where there's market exhaustion, the net difference between the aggressive buyers and the aggressive sellers. And it's from that information that you can start analyzing, is the aggressive buying getting weaker or is it getting stronger? Is the aggressive selling getting weaker or is it getting stronger? Now, earlier I just explained, the volume footprint charts allow you to see the volume traded on the bid, volume traded on the offer. And once you have that information, a trader can then take the data and see the delta, the point of control, and the imbalances, and and find some good trading opportunities. So first, I'll talk about what is delta. Okay, so delta is the difference between aggressive buyers and aggressive sellers in a bar. And if you're looking at a normal candlestick chart, you can't see where traders are being aggressive. You can't see is there aggressive buying or aggressive selling. You don't know what's going on in the aggressive, in the trading. But on a volume footprint chart, you can see where aggressive traders are in control by watching the delta. Now the delta is going to be along the bottom, and what it tells you, right? If it's positive delta, it tells you aggressive buyers are in control. If it's negative, it's going to tell you that aggressive sellers are in control in that bar. So if you see a bar like here at 1234, it's got a delta of -8. It tells you, aggressive sellers were in control of that bar, but it was kind of weak because it was only a difference of 8. It was -8, so it's got a negative delta. Whereas the next bar, you can see the delta is 75. So it tells you it's a positive delta. It's green, right? It's red, it's negative. So it tells you aggressive buyers are in control. So what happens? We went from aggressive sellers in control to aggressive buyers in control. And then the market keeps going up in the next bar, positive delta, 379. So we need a stronger positive delta. So now aggressive buyers are firmly in control, and you can see the market just drifting, going higher, 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 all on positive delta. Now, point of control is the price level in the bar with the most volume. Now, on a normal bar chart, you can't see point of control. All you can see is the open, high, low close and the relation of the open, high, low close. But on a volume footprint chart, you're going to see the point of control with the most volume, right? And why is that important? It's because volume represents, or how to phrase it, represents an area where traders are happy to transact. It represents value. And you can see here in this purple box, I put this box around here because you can see you got 1, 2, 3, 4, 5 bars with more or less the point of controls right around the same level, right? So it's indicating to you that value is being formed, right? And when you have value being formed over time, what is that? That's either support or resistance. In this case, it's support because it's coming in near the low of this move, right? And people are happy to trade here. Buyers are happy to buy. They're happy to accumulate a position. The sellers, are happy to sell, but it's the buyers that are in control right now. Why? Because you can see by the positive delta, even when there are negative deltas, they're still quite small, -31, -8. Right? Then you can see the buyers finally take control of the market after they're done absorbing. They start getting aggressive, and the market starts moving up. Now, imbalances. Now, this is the third part of sort of the building blocks of order flow. They occur when you have more aggressive buyers than aggressive sellers in the two-way auction. Now, most of the time, the market is balanced, right? It's when the market starts going out of balance that trading opportunities arise. So remember what I told you, right? Aggressive sellers sell to passive buyers, and aggressive buyers buy from passive sellers. But when you have aggressive buyers outnumbering the aggressive sellers in the two-way auction by a ratio of 4 to 1, that's considered a buying imbalance, or vice versa, selling imbalance if you have more aggressive sellers than aggressive buyers in the two-way auction. Remember, right? Markets move in two-way auction. So when you look at the volume footprint chart at 39.39 even, offered at 39.39 and you see, there was 220 traded at 39 versus just 20 traded at 39.25, then aggressive sellers are imbalanced. So you have more, in that case, you have 10 times as more aggressive sellers than aggressive buyers. And on a normal regular candlestick chart, again, you can't see where these imbalances are occurring. On a footstick chart, you can see, okay, got aggressive buying coming in here, right? As the market starts creeping higher, all these bars going up, you got these aggressive buyers occurring. You can't see that. This is the same time period on a candlestick chart. So if you're looking at a footprint chart, you can see where the aggressive buyers are coming in. And so once you understand the importance of delta, point control, and imbalances, you can apply them to the market as it's trading, to make good trading decisions. And what that means is, as the market is trading, as it's unfolding, you're able to make instant decisions based on what you're reading in the market. Now, this is yesterday in the evening. Okay, so if you remember, right after 2 o'clock, we hit our high. Okay, so we're at our high. Anytime you're at a high or low, you always got to be asking, what's the market going to do next? Is it going to keep going higher, or is it going to turn around and sell off? Just as if we're at a low, are we going to make new lows, or are we going to bounce? Or are we going to go higher? So here we're at the high of the day yesterday at 57 and a quarter. We got a nice strong positive delta of 660. Right? Okay, well maybe we'll go higher, right? Because we still got positive delta, closing right up near our high. But then if you watch the next bar comes in. It's a red candle. Okay, got negative delta. That's not a good sign. You're at your high of the day. Sellers are all of a sudden in control of the market. What else do you have? You've got 1, 2, 3 imbalances appearing in the bar. Again, it's also very bearish, right? The point of control coming in lower than the previous bar. So remember, if you remember, I just said points of control act as value in a bar. Right? The most traded price is fair price for that bar. So if all of a sudden the next bar is lower, people are pricing the market lower right now. Okay, so the next bar comes in, kind of mixed. You got negative delta, which is obviously bearish. Point of control, is 1 tick higher, and you still have one selling imbalance in there. The bars are doji, it open and close at the same price, so it's kind of neutral. Then the next bar again comes in, negative delta, got a lower point of control. Now the point of control is the same as it was 2 bars ago, so we're sort of putting in value here, but the bars got an imbalance in it, and it's got negative delta. So sellers are slightly in control now. So we're just right up off our high. We got 2 bars out of 3 that are very negative, and then another bar comes in. Right, we got a higher point of control, but again, it's only 1 tick higher. So now you got 4 bars. You take those 4 points of control in the bars here. You can sort of average them together to get one price. You got negative delta minus 284. Obviously, you got a solid imbalance. The bar goes lower. Right, it's not a good sign of a market that's looking to pop around, turn around, and go higher. It's starting to shape up as a market that's getting ready to sell off. Boom, next bar, big strong negative delta minus 1300. The lower point of control. You got just one imbalance, but you can see how the market is telling you from 2 bars ago, 3 bars ago, that this high is probably going to hold for now. Okay, then the next bar, just an inside bar, still got negative delta. Point of control is neutral, it's the same price. You don't have any imbalances, kind of a mixed bar. Then the next bar, again, another inside bar. You still have negative delta. Point of control, same level. You do have one selling imbalance. So, at this point, you got to be asking, is this market getting ready to go back up, or is it getting ready to fall over? Right? There's nothing in here that's remotely bullish. Right? Then you get another bar. It's not an inside bar, just breaks it by 1 tick to the upside. Point of control 1 tick higher. Okay, you got a small delta though, it's only 13, right? Which isn't, for the market to move higher, you're going to need strong positive deltas, not a delta of 13. And you need like 300, 400 positive deltas, meaning aggressive buyers are in control. And there's a solid balance in there. And next bar continues on down, right, as expected. Right? Negative delta, lower point of control. Point of control is coming in lower than these previous 4 bars, where it's all sort of aligned nicely. Right? You got 1, 2, 3, level 1 higher, and then boom, coming lower. So now what's happening? Right? We're rejecting this price at 54 and a quarter, and we're putting a new value area lower. So you can see how the value areas are moving lower. Earlier, right off the high, you had 4 point of controls, which is more or less, you could average those prices to get one level. Here you got 3 at the same level, 1 bar higher. So you have a value here, and then you put in a lower value. Now you start to put in a lower value. And again, you got the big strong negative delta of minus 500. The next bar puts in another point of control at the same level. Got small negative delta, kind of buying and balance. And it's still, it's one of those bars that as a trader you kind of hate seeing, because it sort of muddies up the picture a little bit. You're short already, and you get this green bar, and sometimes traders like to panic and they'll cover their shorts now when they really shouldn't. Balance, I wouldn't worry about negative delta still. You push lower, about 2 points lower, then it reverses and goes up. So this, etc. Candlestick guys, so what's going on in the market right now on a bar by bar basis. But wouldn't it be better? A share eventually I some of these topics. A point of control, for example, again, rather than 50% get up, you'll see it right away. Help them start right here. Because everybody trades differently. Right? We all don't look at a 1 minute chart. We all don't look at a 5,000 volume chart or a 4 range chart. So, however, what type of chart you're looking at, the same things apply in the order flow. Whether you're looking at a 5,000 volume chart, a 5 minute chart, a 30-second chart, whatever, you're going to still look at the same thing. So you can see here it's a prominent point of control at the swing low. Where does it rally up to? Another prominent point of control where the market hits the resistance area and just goes sideways. Use a 1,000 tick chart in the E-mini. You see the two prominent point controls there, putting a cap on the market from moving higher. Here's an 8 range chart. You see that's the double top. You see that's prominent point controls acting as resistance on the move down. Right, for the market to move down, it just doesn't always happen on aggressive selling. People selling the market lower, lower, lower. The big traders are going to be offering it out, and they're going to be putting a cap on the market just as, on a move up. The big traders are going to be offering support in the market, and they're going to be helping bid the market up. Right? And what you want to do is, once you recognize that, you're going to trade in that direction. Right? That's why I talk about, going with what the big traders are doing. So every time, you pop up to a resistance level, you want to get short if you're not already short. Here's gold, right? It's a 1 minute chart yesterday. Going right off that low at 27.80. Yeah, at 2028, a big prominent point of control is sticking out right there. And over the next 10 minutes, market put in a $5 rally. Here's bonds, right? 4-range chart. You can see we're putting in these nice prominent point controls here as support for the market. Market rallies up to a resistance area. Market comes off. Where's it come off to? Now, when you came off, you didn't see the prominent point of controls, but we're coming off right through those same levels. Those were your supports earlier. You came off, you rallied up, and you start coming off. Where do you come off to? You're going to stop at support. Crude oil, right? You see, right? It's off the high of the day. You got resistance selling coming in. Market comes off, rallies up a little bit, comes back off, tries to rally again. Boom, you got another resistance selling, another prominent point of control in the market. As the market sells off to where? Down here, we got two prominent point of controls acting as support. And this is happening in the market in real time. You can see this happening in real time and trade it. You're not saying, oh yeah, there's resistance up here at 42.30, and by the time you're trading it, you're already trading 42.10. No, you can see that instantly. As it's happening. Oh, hey, there's resistance at 42.30. I'm trying to sell 25, so market comes back up to 25.26. You're short. Boom, market sells off down below $42. When you hit these support areas down here at 41.88, down here, prominent point control. Market comes up. Okay, yeah, I got my bids in here on 41.90. Boom, you get filled. Market rallies back up to above 42 plus. So as you can see, some point controls are more important than others, and having software that shows you point controls that matter will put you ahead of other traders who can't differentiate one point control from another, and so put you ahead of those traders who are not even looking at point control at all. Now, what I talk about is imbalances, okay? And a buying imbalance, like I said earlier, occurs when in the two-way auction when there are more aggressive buyers than aggressive sellers by a certain ratio, usually 4 to 1. A selling imbalance is the opposite. It's still a two-way auction, but when you have more aggressive sellers than aggressive buyers by a certain ratio, again, usually 4 to 1. Now, this 4 to 1 is not set in stone. Some people use 3 to 1. Some people use 10 to 1. You could adjust it anywhere. I know some people use 6 to 1. I use 4 to 1. And in some cases, I use 3 to 1. But generally, I use 4 to 1. So how does the trader use imbalances to their advantage? Well, the first place to look is at a bar. I see the candle moving up, green candle, and are there buying imbalances? If so, how many? Candle moving down, there's a red candle. And are there selling imbalances? If so, how many? So again, yesterday's high in the S&P. Right after we hit that high, you can see that bar had 3 selling imbalances. Right? That's not a good sign for a market that wants to go higher. Right? What do you see? So, if you're looking at the Oracle chart, you see aggressive sellers clearly in control of that bar. Right? Now, this is crude oil, right? You can see as the market moves lower, what do you see? You see the aggressive sellers, right? So as the markets move up, you see aggressive buyers, right, in the form of buying imbalances, and as the markets move down, you see aggressive sellers in the form of selling imbalances. Right? Here's the market moving up, and you see all of these little buying imbalances early, right before the big move up just started. Now, most Oracle traders understand what imbalances are and why they occur. The next step is to apply them to the market. Now, stack imbalances is how most traders apply imbalances. And what is stack imbalances? It's a bar that has 3 or more either buying imbalances for stack buying imbalance, or 3 or more selling imbalances for stack selling imbalance. Then stack neatly on top of each other at each price level over 3 consecutive price levels. So like you see the stack buying imbalance down here at 31, 31 and a quarter, there's another one, and 31 and a half, there's another buying imbalance. It says on the selling imbalance, you got one at 33.33, 33, 32 and 3/4, and 32 and a half. Right? These are all neatly stacked on top of each other, and that's all. That's nice. It's pretty looking on a chart. You can draw zones out and try to play the pullbacks into them. For good entry, you can get short or get long for buying imbalance. Optically they're pretty, okay, but sometimes by the time that you see them, the market is already putting a big move, because sometimes when they appear, it's a bit of FOMO, right? Traders have missed a move and they're sort of rushing into the market. And I tell a lot of people in my weekly classes, there are 2 problems with dealing with imbalances. If you just wait for stack imbalances to occur and trade them, sometimes you're waiting for a long time, you're going to miss a lot of great trading opportunities in the meantime. And some bars have imbalances, some bars don't. The bars that have imbalances, well, which imbalances matter? And some bars have no imbalances. Okay, some bars may have 1, some bars may have 2, some bars may have 3 or more. What bar do you think has the potential to move the most? A bar with 1 imbalance, 2 imbalance, no imbalances, or a bar with 3 or more imbalances? Well, obviously, the answer is a bar with 3 or more imbalances, but not necessarily stacked. Right? I said, a lot of traders spend a lot of time looking for that stacked imbalance that never comes. So bars with 3 or more imbalances. Okay, so you can see a nice stacked imbalance here as you're breaking through this low of the day here. This red line is the low, 33.35. Yeah, nice stacked selling imbalance here. See, that's great. The market continued to move all the way down to 29 before reversing and rallying back up. But look at the bar 2 bars earlier. It's got 4 selling imbalance. Okay, and that's coming in 2 points higher than the stack selling imbalance. Would you rather have 2 extra points in your move? Then on the way back up, you see any stack buying imbalances? No, there is none. But you see 1 bar with 3 imbalances, another bar with 3 imbalances, another bar with 4 imbalances. Right? Do you think this information is useful to you? Of course it is. the order flow trader software will put a box around the bars with multiple selling imbalances, 3 or more imbalances, either selling imbalances in the down bars or buying imbalances in the red bars. Right? So I talk about letting the software do the work for you. And again, if you're not using software that's going to highlight this to you, you may not see that right away. By the time you see it, you may have missed the opportunity. Right? And trading is an opportunistic endeavor. Right? You got to take advantage of this stuff as soon as it happens. Right? That's where your edge is going to come in, is by getting in on trades that other people are just completely missing for whatever reason. Okay? So again, here, look for the imbalances. Okay? So I just talked about these prominent points of control and how important they were. But did you know that these bars also have multiple selling imbalances in there? Okay? So it's telling you, there's resistance in the market with prominent points of control, and there's aggressive selling. So 2 bearish points. Honestly, we live in a great time for traders. Computers are affordable, easy to open a trading account. Markets trade around the clock. So it doesn't matter if you're working during the day, you come home at night, you can trade E-minis. And now they have micro contracts that you can trade that have very low margins. Back in the, just 20 years ago, to open a trading account, to get a low commission rate, low was considered, $10 a side. Even before that, back in the 90s, $20 a side, which is $40 a round turn, was considered discount already. And now we're living in places where they have day trade margins. So literally, there's brokers out there. I'm not pimping any brokers, but there are brokers out there that you can trade. You can open a futures account with $300, $400 and trade the micro contract with $50 margins. It's a great way to get started. You don't have to go all in and trade full margin. If you go open a small account with $300, just trade one micro. You don't need to get $50 margin. You don't need to trade 10 contracts on a 500. Just trade one. Get used to the market. It's a great opportunity to get started at low cost. Like I said, it's a great time for traders. Now here's gold, right? Can you see what's happening in the market, right? Yeah, you can see the stack buying imbalances as the market is going up. Okay, that's great. Then it hits this point here at 29, and then it just falls off from 29 down to 25. Okay, but if you're using software that's going to highlight things to you, right? You see with the arrows here where the multiple buying imbalances are, and multiple selling imbalances are, and then up here the prominent point of control. Let the software highlight all that information to you. Boom. See, you've got the pink box around it. You've got the prominent point of control, the bearish prominent point of control up here, followed by a bar with multiple selling imbalances. And again, you could be getting short in here at 28, well before it breaks down here at 26. Most traders are going to see this move. They're not going to know right away to get short unless they're looking at the order flow. Obviously, you can see the delta is all negative up here. This is last night at just after 10 o'clock. Okay? It just shows you, like I say, it's a great time for traders because there's liquidity around the clock. You can trade a lot of these markets in the evening time, even if you're working. And again, you don't have to be going all in and trading at full margin. You open an account with $2,000, you just trade one lot. Simple. On a normal bar chart, right? You're not going to necessarily see that. You'll know there's, but on the chart, you're going to know there's resistance, and you're going to know there's selling imbalances by watching the order flow. Right? Some candlestick guys say, well, you got that type of candlestick here. Well, you had a similar one there. Then you had a lot of bullish candlesticks on the way up. That's neither here nor there. That's an argument that is often had after the fact. But as a trader, you want to be alerted. Okay, yeah, I got resistance up here based on the order flow. I've got aggressive selling based on the imbalances in the order flow. I've got negative delta that's telling me sellers are in control. We just made it high, but there's negative delta. Right? Do you think the market's going to go higher? No, it's not. You're going to need aggressive buying for the market to go higher. Instead, you're seeing the opposite. You're seeing resistance selling, you're seeing aggressive selling, you're seeing each bar being in control by sellers. Right? That's not a recipe for a market to go higher. That's a recipe for the market to go lower. All right, so hopefully by now you can understand. Order flow is a great tool for traders to understand what's happening in the market. And honestly, there's so much more to cover. For example, I didn't even talk about these little red arrows on top of bars, these little green arrows. These are bullish and bearish instances in the order flow to either get you into trade, or if you're in a trade, keep you in the winning trade longer. That's where real benefit is for many traders, is being able to manage a trade. And that's something that goes sort of hand in hand. A lot of people says you got to cut your losses short and let your winners run, but they don't actually tell you how to do it. When you read the order flow, you can see whether the order flow that's happening after you're in a trade is bullish or bearish. So if you're bullish and all of a sudden you see a bunch of bearish order flow, that's not a good sign, right? So you got two choices. One, you can let the market just go and stop you out. Or two, you can pull the plug on a trade, get out early. Now, if you're long and you have bullish order flow following after you get into the trade, that's good. You can let the trade run longer. Right? That's how you let your winners run and cut your losers short, by managing the trade. You don't let your winners run and cut your losers short by throwing in an arbitrary stop and take profit based on an average over 20 trades. No, you watch it by what's happening in the market. It's for a trade to become profitable, you need the order flow that follows once you get into that trade to go in your direction. If it's not going in your direction, trade is going to struggle to turn a profit. Now, I covered these topics such as what all these little green and red arrows mean. I generate from my software and numbers above and below the bars for in my weekly group training session for users. But I'll tell you about more of that in a minute. But hopefully by now you should start putting together the different parts of order flow, and you can see the market makes sense. Order flow analysis provides the trader advanced information they need to gain an edge over other traders. So that's all I said. You gotta have an edge in the market. And then they don't tell you how to get an edge. Order flow gives you an edge. It allows you to see and understand what's happening in the market that other traders just don't see. So hopefully you can see how powerful order flow analysis. Remember, don't overcomplicate trading. People like to overcomplicate trading for some reason. I got to throw 10 indicators up on my chart. I got to throw 5. Okay, what's your best indicator? Read what's happening in the market right in front of you. So if you found this helpful, you're going to like my Order Flow Trader 2.0 software package, which makes the analysis easy. And there's 2 ways you can go about becoming a successful trader with order flow. One, you can try and learn order flow on your own. It's going to take you years by looking at a screen and trying to figure out order flow. I spent 25 years trading. Okay, it's not something that comes instantly. For some people, it does. People are autistic or can pick things up really quick. And more importantly, you don't want to waste years and money trying to learn it. Right. Second way is get the education software from a trader who's successfully traded order flow at the highest level for decades. Skip the massive trading losses. Skip the waste of time. Sort of go to the front of the line. Remember, order flow is the most current information available from a trader. And it's not some indicator, it's the market, right? Order flow is not based on pivot levels, it's not Fibonacci, it's not based on Elliott Wave, it's not based on SE, etc. It's not based on VWAP. Order flow is what's trading on the bid and what's trading on the offer. Basically, it is the market. You're trading the market, right? You're not trading an indicator, you're trading the market. So the Order Flow Trader 2.0, I was telling you about earlier, it runs on NinjaTrader 8. It'll run on the free version of NinjaTrader 8. So if you're using a broker's trading platform, you can download the free version of NinjaTrader 8 and load up my software on it, and it'll run there. Obviously, you're going to need to pay for a data feed. And what it is, it's a volume footprint chart with 7 pre-programmed order flow indicators. So I'm going to get my chart template, so your chart could look just like mine. I don't spend hours trying to figure it out. Normally, I sell it for $899, but I realize, having order flow software is one thing. The next thing is to know how to use it. So I don't just give you the software and send you on your way. Try and figure it out. No, I provide a lot of education on how to trade with order flow. Now, each week, it's Tuesday, so I have one tonight. I do a private live group training session just for users. You can attend, you can watch recordings. There's over 80 recordings now. Some gurus, like to charge extra for this. I give it for free. Why charge you extra for training on how to, how to use the software, how to read the market? That should be free. It's ongoing. I got guys that bought my software 5 years ago that still attend the session. They still love. Sometimes I'm late to sending out the invite for the training session, and you guys will hit me up. Hey, I have a session tonight. It's amazing. The best traders are the traders that want to learn. I also give you access to my Order Flows trading course, which I normally sell for $297. You get access to that for free, as well as my Inner Circle video series. Normally I sell this for $497. And what it is a collection of 56 advanced videos on advanced order flow tricks, but nuances, tips, and analysis. You can get it for free. Each video is about an hour long. So, $899 for the software, $297 for the Order Flow trading course. The Inner Circle is another $497. The weekly group training, I don't know, put a price on it. Again, some people have been attending that for years. So that I can't even put a price on.
ये है ब्रेकआउट और आप एंटर करोगे यहाँ पर ब्रेकआउट होने के बाद
What can I get you?
I want a job where I can help people.
I want a job building rockets.
I want to work somewhere creative.
All right, guys, I'm Big Mike. Like always, I want to thank you for being here today. Today we've got Futures Trader 71. For those of you that don't know who that is, he is a very well-known, very well-respected professional trader. He's got over 10,000 followers on.
Since I became a registered broker about a year ago, there are regulations I have to comply with, so I need to make sure that everyone hears this disclaimer. You need to know that derivative transactions, including futures, are complex and carry a risk of substantial losses. Are not suited for all investors. Futures are leveraged, so you can lose more than the value of your initial investment. The information shared here during this presentation is for educational purposes only. It is not intended for use as trading or investment advice. Past performance is not indicative of future results. Who am I? I started out as an equities trader. I traded for what's called, with a group what's called the SOS Bandits through a company called the Holt Brothers. I started down in Florida, quit my normal day job and joined the crew and put up, I think it was about $45,000 or $50,000 and started to try to learn to trade equities at high speed, mostly scalping momentum on stocks like JDSU, Dell, Microsoft, and so forth. It wasn't, I just started turning the corner when 9/11 hit, and before that, some changes occurred on the NASDAQ exchange that we were trading on. And this is the first time that any old person can have direct access to a level 2 screen and trade live and in real time, just like a bank or a mutual fund could. So we got in there and we would front run orders, very large orders by various funds and entities, banks, and so forth. And some of the guys I traded with did really well, but then learning to trade that way is also conducive to losing very quickly because you don't actually learn the important aspect of risk management and so forth. Once that game dried up because of decimalization and fees and regulation and so forth, I had an opportunity through a friend to come up to Chicago from Florida. I think I got a call on a Thursday, and I was told that there's some proprietary Trading positions, proprietary trading means a firm sets up a fund or its own account, and then it hires traders to trade it. And you trade it, trade the markets, and you get a split of the profits that you make. So in most cases, it used to be 50-50, and now it's a lot less. I think there are deals that are 25%, which is really awful. But I heard about the opportunity on Thursday, and I packed up a car with this friend of mine, and we drove up to Chicago, and we're here Friday. That's how desperate I was to continue to trade instead of going back to a regular job. And then by Monday or Tuesday, we had a deal, and then I moved from Florida to Chicago to learn to trade futures. The pattern here is that I always traded around and with professionals, so I wasn't at all exposed to trading from home or the issues related to that, and I became familiar with those issues around 04, 05 is when I started to see what the issue was with trying to be a trader on your own. It's doable, but it's not as easy, or it's a little more complex than doing it in a professional environment. Within 9 months or so, I became very profitable. I went through a substantial drawdown in my prop account. I became profitable and actually was net positive in about 9 months. And I noticed that there were some irregularities within the prop trading firm that hired me, and so I got myself 9 months to learn to trade futures. The pattern here is today and 5%, which is really off. In most cases, it means a firm sets up a fund or its own account, and then it hires traders to trade it. And you trade it, trade the markets, and you get a split of the profits that you make. So in most cases, it used to be 50-50, and now it's a lot less. I think there are deals that are 25%, which is really awful. But I heard about the opportunity on Thursday, and I packed up a car with this friend of mine, and we drove up to Chicago, and we're here Friday. That's how desperate I was to continue to trade instead of going back to a regular job. And then by Monday or Tuesday, we had a deal, and then I moved from Florida to Chicago to learn to trade futures. The pattern here is that I always traded around and with professionals, so I wasn't at all exposed to trading from home or the issues related to that, and I became familiar with those issues around 04, 05 is when I started to see what the issue was with trying to be a trader on your own. It's doable, but it's not as easy, or it's a little more complex than doing it in a professional environment. Within 9 months or so, I became very profitable. I went through a substantial drawdown in my prop account. I became profitable and actually was net positive in about 9 months. And I noticed that there were some irregularities within the prop trading firm that hired me, and so I got myself fired. And when I did, by that point, I was already training new traders who were being hired by the firm for a split and so forth. So I had a little bit of a background in mentoring and so forth. So I split off and I started to trade on my own. I went to Advantage Futures at the time, and they had just opened their doors to private traders, and I was one of their first clients. And just to set up in a main trading area, and then started to bring people over, mostly friends who wanted to trade and so forth. And then eventually that turned into having my own room within Advantage Futures and becoming a full-blown prop shop. It just seemed like trading with others was a lot better for me, and I did a lot better doing that. And so I became a prop futures firm owner within Advantage Futures office. I later, I think in 08 or 09, I left Advantage and set up an office elsewhere in the Board of Trade, but that's basically the pattern. In 05, I noticed that my traders and myself had to trade a lot bigger to make the same amount of money. At this point, we still were momentum scalpers. I would scalp anywhere from 1,600 round turns a day to 3,200 round turns a day. That's our method of trading. And with machines taking over the high-frequency domain, it just became harder and harder to extract profits from the market. So I started to look elsewhere to sustain my business. I started to get online and look at forums like Big Mike's, and others, and started to, I chose this name, Futures Trader 71, and it kind of stuck since then. I began to reach out to other traders online to see what they were doing. The trading world's very secretive. Most traders don't like to speak about their edge because they're under this, what I believe is an illusion, and it is an illusion, that if you talk to someone about what you do and how you do it, that somehow you're going to not be able to make money anymore. And that's unless you're trading an automated trading system. This is simply not the truth, because your success, and we'll discuss this later, your success in trading is not about, here's the technical signal and take it. Your success and many people's failure in trading is attributed to their inability to modify their behavior and their inability to execute when they're supposed to execute. So, and that's covered in some of the webinars that I have on my website that I did for charity and tell people out, but we'll talk about that later as well. So I went out and started to look for an education. So I joined my first education. Well, I took a seminar. I flew down to Atlanta and took this seminar, and I paid money for it to try to learn how to trade, market profiling as a professional. And it was obvious to me from the beginning that those people who claim to educate and know, Hang on a second. I need to turn off Skype. Just 1 minute. Sorry, just didn't want those things to pop up. I just learned that people claim to know so much, but they don't really, they teach because they don't know. And so I started to kind of feel the pain and be exposed to the pain of trying to find a resource for information to learn a profitable edge. So the next step after that, I joined a paid chat room. I paid for a chat room and I joined it and started to look in there. It was a market profile chat room, and it seemed more like a circus and a lounge than real trading. It was very inconsistent. I tried to improve the environment that I'm in wherever I go. I'm not trying to sound immodest, but that's really a value that I hold to. And so I started to contribute a lot. I started to call out live trades, and I was quickly made a moderator in that chat room. And things were going well, but I think a few of the people who had been there a while and had some influence just didn't get along with me really. I would call people out, and people don't appreciate it. I was just being arrogant. People don't need to be called out. And then I decided so I quit that, and I decided to create something better. So I went to Ensign Chat and created my own chat room for free, where you can only join through recommendations, recommendation by an existing member, and that went well for a while, but it was very draining and it was very distracting to my trading. So I next took a kind of disappeared for a while, and then a friend of mine said, "Hey, let's talk over Twitter. You should check this Twitter thing out. Let's talk over Twitter." And what I would do is get on Twitter, and this was in mid-09. I would get on Twitter and I would just tell them, "Hey, this is what I'm looking at. This is where I'm going to get short. This is what I'm stocking. This is what I expect. My hypothesis for today is this, this, and that." And we would chat back and forth. And then one day, the market was so dead, I just used a cuss word. And he wrote back and he said, "Watch what you're saying. You have like 350 followers." And I didn't understand what Twitter was at the point, that people subscribe to your feed, by just following you. And so I realized that all these people had been following me. I'm making myself sound really old and ignorant, but I'm not. But I just didn't look into what Twitter was. So pretty soon people started to ask questions, lots of questions. I started to answer them. You had only 140 characters to do that. And then what I would do is, because there were so many questions, I would go to these places like tinychat.com, where I would just open up a webinar and allow anyone to join, and we would just talk. And I would try to record the screen and shoot it out to people who wanted it. And then eventually I was invited to speak for Hamzai Analytics. He at the time had a pretty decent following. He had about 3,000 users. And I came on and I did this talk in November of 09 about overcoming the inconsistencies, overcoming the obstacles to consistency. And I'll give you the link to it there, and Anthony will post that same link. I suggest you watch it. It's a basic run-through of what I do, but it had a little more detail than I can cover today. And that set things off. And then folks started to suggest that I maybe create a blog and just answer these questions in a blog post, so that I don't have to keep answering them. I can just refer to the blog. So I created a Google blog, a Blogger blog, and that wasn't enough. It became overwhelming. People found me. I think I've received over 6,000 emails from folks who need help, and I want to help everyone, but it just becomes very tedious and overwhelming. So what I decided to do is I'm either going to withdraw and go focus on trading and building a new prop group, which is what I really wanted to do, or do something different, start charging, or get a clerk, get somebody to run the thing, so that it just I don't have to deal with the technicalities of posting a video and recording it and all that stuff. And then a follower suggested, "Well, hey, why don't you just create a webinar series and charge for it?" And I thought, no, I don't want to be somebody who charges for stuff that that they need to be able to trade a little bit better. But I also started a charity in January of 08, and we lost some funding for that charity. And I thought, and it was a tax-exempt 501c3 charity, and I thought, that's a win-win. I can create the webinars in a series of about 12. I just took my training manual for my prop shop, and I started to take material out of there and go over it. And so I thought, okay, I can just have the charity create a PayPal, and then people will donate to the charity, and then they would get these webinars. And that's really then things took off. I got more with doing that. Somehow I earned people's trust, and that I wasn't taking their donation, and it just went to the charity, and then they would just get the videos, and I would just spend a lot of time just creating the videos. And I created 4 of them before I had to stop. This, of course, generated even more attention, more questions, more demands, more requirements, and it just interferes with your trading to try to keep up with that stuff. And at the same time, I'm still tweeting my fills, still telling people what I'm going to do, and so on. So it occurred to me at a point last year, in the summer of last year, talking to a broker friend of mine and I, that, hey, these people really need help. Anybody who wanted brokerage, I would push them to Anthony, who now works with me at Vancar. And but still, I didn't know about people's issues. Like I didn't know if people were following their plan, if they were doubling down on losses and so forth. So I thought, if I became a broker and started a brokerage, I can create something that's similar to a prop shop. And so what I could do is continue doing what I love, which is trading, education. I just enjoy the process of watching someone, not the struggling part, but they have to go through the struggling part, but watching the light bulb go off and watch their life transform completely through their success. And so we started to pursue that venue, and so we thought, okay, we can create something that took some coaxing to get Anthony to finally come over, but I finally got him, and we started this brokerage in November of 2011. So with the brokerage, what I can do is then offer my education to a smaller and much more focused group, and go into more detail. Because what was happening is, through the webinars and my chats and so forth, and you can go to my website, it's listed at the bottom, and you can go to resources and look at the chat archive to see how many chats we've done in the different subjects, and it's just a wide array. And then, because of the questions generated, I started to make the chats member only for the website. To be a member, you just had to get one or all of the webinars. It didn't matter, just to stem the flow of questions and requests. And so, I thought, instead of speaking in general, those people who invested in us and brought their account over and used the tools that I would create for them, tools that I had created for myself using XTrader Pro or whatever, I had people program things for me, now have been adapted to the brokerage. And so they can come in, and then I can focus on this group. Because what was happening is, those webinars that I put online would be, I would get somebody subscribing and watching them, and then the information was being plagiarized, and it was being offered out at much higher prices by others. And so I figured I would invest in the clients that were investing in us. And last week we started our webinar series for clients, and to talk about specific things using the tools. And then that's where I'm pursuing the learning program. I'm still continuing with the online Twitter stuff and the website and so forth, because not everybody can be a client, but it just allowed me to focus a lot more. So it gave me a kind of a 20/20 vision type of idea. In addition to that, so let's just follow the slide here. So education will be focused on clients. Being a broker, I can see what they're doing, help them manage risk, and to disrupt bad habits. And that's what I do all day long, as I sit there, trade, do other things. And then if one of our risk alerts go off, and we have a risk alert for each client, then we watch what they're doing. I pull up the trade analyzer, I look at their trades, I look at their statistics on their trades, and my job is to determine, are they trading out of their monkey, what I call their trading monkey, or are they trading and following a plan, but they happen to take a series of losing trades. And so that's what we're building. So what I had created is something incredibly unique, in that I'm creating a remote prop trading group, but in the form of a brokerage. So you're risking your own money, and it kind of separates. What it does is it separates those people who just ask you a lot of questions and frankly waste your time, and that they ask a billion questions and then try what I'm talking about for a week, and then they move on to the next guy, and then they go to another form, and then they go to another form, and essentially multiply that by 1,000 times, and it's just very draining. Just a side note, I can't see your questions yet because I'm on my laptop. I'm actually traveling. Anthony's going to try to take care of the questions as much as possible, but there will be a time at the end for me to address specific questions. So I don't want you to think I'm ignoring you. So we joined forces with a clearing firm to clear our trades, and we're using their trading platform labeled to us, and then we started to adapt some of the tools I used and created for my personal trading and for my traders for use with our trading platform for clients. We're building our own high-performance trading platform and execution system within Vancar. We're hoping that'll be released in about 2 to 3 months. It's built from scratch. It's built on Flex. It's for those who auto-execute their trades, as well as traders, just self-directed traders. But we also execute our auto trading systems on them, because that's what Vancar is known for, is creating high-quality auto trading systems that trade on people's accounts. Then we hold client-only webinars to cover a continuous process of education and support. I get to know my clients personally through their trading by just talking to them. I pick up the phone at least once a day to call someone and say, tell me your plan. What is your risk for this trade? Why are you trading here? Just to make sure that their emotions aren't taking over. And that's really what gets you as a trader who's inconsistent. It's your emotions. It's not your whether your fibs are correct or whether you're fibbing the right prices. It's really your emotions. And I spent a lot of time demonstrating that. And in fact, yesterday's webinar for clients was about entries and talking about how important or unimportant entries are versus trade and risk management. We continue to provide more exercises. So in webinar 3 on my website, it covers psychology, which I think is the heavy part of trading. My skill as a trader, and I've probably traded, I don't know, probably 1 million contracts in the last 10 years or so. My skill as a trader has nothing to do with my tools and my approach. It has a whole heck of a lot to do with my belief in the market and in my belief that probabilities dictate what trade I take. And so I'm trading from a probabilistic perspective rather than an emotional one. And there are days where I have lapses, and I have my one monkey where I get emotional, I didn't sleep well, I get irritable, and I end up getting myself in trouble before realizing that I am. And that as I grow and my experience grows, what happens is I become better and better at recognizing the monkey and stemming it, stopping it. And that's something that I know struggling traders have a hard time with. We now have the statistics, so through this brokerage model, we now have the statistics, trades, and details needed to help a trader. You know, like I think of Mike, for example, the person who runs this forum. Mike probably gets hundreds of emails of people trying to figure out if this is legit, that's legit, if their approach is right. And Mike is probably answering those as much as he can. He's probably saying, yeah, you know, this works for me, and I think using that works for me. And this person will write back. And so Mike's going back and forth. You know, he's developing this, whether he likes it or not, he's developing a kind of a connection with this email he decided